So you might be asking me what a butterfly is in regards to trading options in the stock market. And I'm here to explain it to you. For those of you who don't know, my name is Allison Ostrander. I'm the Director of Risk Tolerance over at Simpler Trading, and I will be happy to walk through what a butterfly is. Let's dive into it. So, butterflies are a non directional strategy that is great for choppy or consolidating charts. They can also be a directional trade if you have a target or level that you're eyeing, which we'll go over here with a real life example on Google in a second. To just describe what a butterfly is, butterflies consist of two vertical spreads, a vertical credit spread and a vertical debit spread, both either on the call side or the put side of the option chain. And both the credit and debit spread will share the same expiration to create a butterfly trade, right? So we're not mixing and matching expirations, it's all within the same expiration. And you cannot lose on both sides of a butterfly. That is the beauty behind it. Because of this, it creates a great risk versus reward scenario. A standard butterfly, which is what we're going over here specifically in this video. There are a lot of different types of butterflies, but the most generic version of it, right, the simplest version to kind of start off with to understand the more complex ones is what most people will refer to as a standard butterfly. And a standard butterfly will have both the credit spread and the debit spread share the same spread width. For example, if the credit spread is a 10-point width between the two strikes, the sold to open and the bought to open strike, then the debit spread is also a 10-point width between the bought to open strike and the sold to open strike. Keeping the same width on both spreads will allow for a lower capital cost compared to different widths. On a standard butterfly, the short strikes of the credit spread and debit spread will be the same strike. So, for example, if the short strike on the credit spread is the 250 call, then the short strike on the debit spread within that same expiration is also the 250 call. For the max profit potential, you want to see the underlying price settle at that short strike, aka at that 250 level. That is what will give you the max profit potential. So that's kind of like the basics behind it, right? But if you're still kind of scratching your head, like, I'm not quite sure I'm getting it, for me, I know what helps me out a lot is actually walking through a real life example. And so I found a setup here on Google that I really like. I might actually jump into something like this. um, but let's pull up the option chain over here. I'm going to use Tasty Trade for this. And so we have the expiration. This is next week from when this is being recorded, October 10th, 2025. And right now, today, this is what the Google chart looks like. So, of course, Google's a beast. It's been in this nice bullish run recently, finally getting a bit of pullback into support. We're getting a good reset on momentum. And so, with this butterfly trade idea, what I would be looking for right now is basically for this level to hold and a bounce to play back up towards this 252, 255 range with the idea that it's still taking a breather, meaning that it's not going to keep going to the upside. It's just going to look for a bounce and still maybe stall at the recent highs while momentum continues to reset to the zero line. So, if that was really my conviction behind this right now, a standard butterfly would make a lot of sense. And the reason why is because I am looking for this to have a directional move, but I'm really not thinking that it's going to get above this 260 level right now. So I think it will bounce up, but that it will kind of be range bound, at least going into next week. So a standard butterfly is a great strategy to consider if this is what I think Google's going to do into next week. So let's take a look, right? As we talked about just a second ago, a butterfly consists of a debit vertical spread and a credit vertical spread within the same expiration. So we're going to stay in the same expiration. They're either all the strikes either live on the call side or the put side. Because we're looking for this to bounce, we're going to lean towards the call side. And because we know that it's not really going to get above 260, we think it's going to hold the current level it's at and try and move a bit higher. What would make sense for a standard butterfly would be something like this. Now let's break it down a little bit, right? As I mentioned, a butterfly consists of a debit spread and a credit spread. And a standard butterfly, which is what we're talking about here in this video, is the same spread width on each side, and they both share the same short strike. So here is a debit vertical spread. The reason it's a debit vertical spread is because our bought to open strike is closer to at or in the money than our sold to open strike. If I were to open just these two strikes together, it will create a net debit right now of about 285. But a butterfly also consists of a credit spread. So we know that we'll be using the same short strike and the same spread width for the credit spread, which will look like this, right? And the reason I know that this part of the trade is a credit spread is because my short strike is closer to at or in the money compared to my bought to open strike, right? My sold to open strike, my short strike is closer to at or in the money compared to my bought to open strike, my long strike. And you can see if I were to open just these two strikes again within the same order ticket, it is showing up as a net credit. Now, this doesn't mean it doesn't have any risk around the trade. It does, right? Currently, if I was just to open this by itself, it would have about a 613 risk versus a 137 profit potential. Not exactly my risk first reward cup of tea, but I know some traders out there who like to do out of the money credit spreads like this and make it work out for them. But I like for that risk to be smaller and that profit potential to be greater. So because I think Google is going to bounce but not exceed 260, I want to put on a standard butterfly. So we have the debit spread and the credit spread. Now, the important thing to note is you need a short contract for each side of that spread, right? So one of these two contracts is a part of the debit spread, and the other contract of this short strike pairs with the credit spread. So as I mentioned earlier in the video, I cannot lose on both sides of this trade. If this butterfly closes completely out of the money, I technically won on the credit spread and I lost on the debit spread. If this trade goes completely in the money, meaning Google is above 260 by next week's expiration and I haven't closed out of it before then I win on the debit spread, but I lose on the credit spread, right? Because debit spreads you want in the money, credit spreads you want to keep out of the money. And this is where butterflies can sometimes trip up people, because you might be asking the same thing I first asked myself when I was learning options, which is, well, how does this trade become profitable, right? It kind of feels like it contradicts itself. And the reason why this trade can still be profitable is because we're looking for a move up, but ideally we want Google to stall out right at our sold to open strike by next week. That would allow our debit spread side of the butterfly to be completely in the money, while the credit spread side of the butterfly is still out of the money, meaning both sides of this trade idea are profitable. This is why butterflies are oftentimes a very low risk strategy with a really nice profit potential. For example, instead of just buying the long call at 520, instead of just buying a debit vertical spread, which is a little bit cheaper, but still $296 in capital cost per contract, I can look to open a butterfly for a fraction of the price. If I were to open this butterfly we're walking through right now, it would cost me $1.57. This still leaves me a max profit potential, as you can see over here, of around $5.94, depending on where my fill is. Let's just meet in the middle. Let's say I got a fill at $1.55. So it is a $5.95 max profit potential. Meaning if I were to close exactly at the short strike, and let's just pretend Google cash settles, it does not. There are risk of assignment, so I'd be out before market close personally. But let's pretend it's like SPX and it cash settles. The max profit I could get is $5.95. That is an excellent risk versus reward, in my opinion. That's exactly what I want to see. And so the idea behind this trade is we do want it to continue to bounce up some, but we don't want it to exceed that farther out of the money bought to open strike that's part of the credit spread side of the trade at 260. If it starts to exceed that, then that's where we could start to lose money again. We really want Google to stay in between 245 and 260 in order for us to take that profit. And so as time continues to move on, as we get closer to next week's expiration, if this can continue to bounce, but remain range bound like we're seeing here, the credit spread is going to start to lose value like we want to see, while the debit spread ideally is pushing further in the money like it's already starting to do and is gaining intrinsic value by being in the money. That will allow the value of the butterfly to increase and therefore allow us to be able to take a profit on it. So I hope this helps explain what a butterfly is, right? Just for the short clip note version, it is a trading strategy that takes place all within one expiration and all within one side of the option chain, either all calls or all puts. It is a combination of a debit spread and a credit spread that share the same spread width, in this case 750, and share the same short strike, which is the 252 strike. One of these contracts is paired with the debit spread, and one of these contracts is paired with the credit spread. Ultimately, for a butterfly, you want to be right around your short strike by expiration to allow for that max profit potential. So you can trade it as a slightly directional trade like I'm looking to do, with the idea that we are going to get a bounce in Google, but not maybe as past 260 by next week. Or if you're a bit more range bound, right, you can move your strikes around accordingly with the idea it's not going to break support, it's not going to break resistance, and you remain in the middle for that butterfly to continue to gain in value. As always, my fellow Jedis, may the trade be with you. If you want more information about how to trade options and different strategies, please feel free to subscribe to my channel and like the video. Until next time, bye.